do you think that a failure to delivery is possible? Do you see that as being possible, the start of something that kind of breaks the system?
I think London, essentially, the London silver and gold market is a smoking hole right now. And what we see is acquirers, the industry especially that absolutely needs the metal, are stepping in and trying to acquire the metal as they can. And I don't think this process is going to take too long. I think we had a default. The lease rates were telling us that somebody couldn't get metal, the implied lease rate. I don't know what the actual lease rates were, but I suggest they would be materially higher than that. And that what we see right now is a pause for a couple of weeks. 50 million ounces come from China and New York and Switzerland to kind of give a little bit of a patchwork covering to what is going on in London, but that we are now in a rolling failure of the London market. Let me put it out.
The growing strains within the global precious metal system are becoming increasingly difficult to conceal, especially as physical demand exposes fractures in markets that paper claims have long dominated recent disruptions, ranging from sudden liquidity shortages to delivery delays, highlight the fragility of Western exchanges. Large daily trading volumes now sit atop an increasingly thin physical base, making the system extremely sensitive to any real-world buying pressure. Meanwhile, the rise of competing Eastern markets, export restrictions, and strategic accumulation policies is accelerating the shift of metal away from traditional hubs and toward regions determined to secure supply under their own terms. Andy Schectman, a longtime bullion dealer deeply embedded in wholesale flows, and David Jensen, a market analyst known for studying structural weaknesses within the LBMA and COMEX frameworks. With London increasingly dependent on emergency inflows to meet short-term delivery obligations, confidence in its role as the center of price discovery is fading. As global tensions rise and monetary systems fragment, the competition for trusted metal sources intensifies. The result is a historic transition from synthetic price signaling toward a market where physical ownership defines value and credibility. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Explain what are the key points of failure that you see, maybe starting with the backwardation.
Yeah, well, we did see on October 10th, the market seize up in London. And that is despite the fact that they had roughly 790 million ounces in the vaults in London. But of that 790 million ounces, approximately 650 were held by exchange-traded funds, so it should not be offered into the market. And the remainder, which was approximately 140 million ounces, was not offered to market. So what we got there, Andy, was on that day, we caught a glimpse of where the bottom of the barrel was. And the London market actually bounced into that bottom of the barrel. So even with 140 million ounces not available, not held by the ETFs, there was no silver liquidity in London. So we know that that market is tapped out circa 140 million ounces of non-ETF gold. So with the addition of, notionally with the addition of 54 million ounces to that market, they've got a little bit of liquidity. But I mean, even the LBMA now in their statistics state that they're trading on an active day, they're trading more than 700 million ounces of silver every day in the cash immediate delivery market, immediate ownership and immediate delivery market. So if you've got 50 million ounces, but you're trading 700 million ounces a day in these cash contracts, and that speaks of an open interest or total claims in the market of at least a couple billion ounces, you can see how weak this market is, and that the market has actually failed. It's just a matter of the London market has failed. It's a matter of it, silver purchasers recognizing this. And I think what we're seeing today with these 4+% price moves after the price had come off 10-15% here a couple of weeks ago, is that investors and purchasers are stepping in to acquire what little silver is left in that market. London right now operates, on a silver in, silver out basis. If they get silver, they can deliver some silver. If they don't get any, they are unable to deliver silver. And we saw that from that signal. They've got a 50 million ounce buffer right now, but they are dependent on continual deliveries of silver to meet delivery demand from these cash contract holders.
Yeah, I cite your information regularly. And when we talk about the LBMA, they, for a good portion of the year, it's a T+1 exchange. T for the trade day, +1 to settle on the third day. Those bars should be moving.
Yep.
But as you know, it was 8 weeks because we were told the Bank of England had a shortage of manpower and trucks. And I cite your figures regularly in the respect that, you say there's roughly 2 billion ounces of deliverable contracts out there against a 140 million ounce float. What could possibly go wrong? Or trading 700 or 800 million ounces a day in deliverable contracts against a 140 million ounce float. What could go wrong? Or even Bruce, I forget his last name, Ikamoto. I'm sorry, yeah. Bruce. He talks about 3 million ounces of platinum traded every day with 0 platinum in the vaults. What could go wrong? My question to you that I think is paramount to your analysis is, how confident are you in the LBMA's reported trading volumes and inventory figures? Kind of the same way I wonder, the CME group, how accurate are their figures on the Commitment of Traders report? But how confident are you in the LBMA's reported volumes in trading and in inventory figures?
That's a good question. It's very difficult to say. You're dependent on these the banks, which have on numerous occasions shown themselves feeling free to operate outside the law, number one.
Yeah.
But I mean, in 2013, the LBMA was indicating that they were trading about 2.5 billion ounces of silver a day in the cash market. 2.5 billion in a world where you're producing 800 million ounces a year. Now suddenly that number has dropped to around 700 million ounces a day. So we really don't know. It's an opaque market run by banks which have been charged with fraud on numerous occasions. So we really don't know. But the idea that the 140 million ounces is a float, I mean, that's the amount of silver not held by ETFs. But if you want to talk about a free float, what is available to London when you're at the 140 million ounce level right now, the free float is 0.
It's the 55 million ounces that they got injected in there.
Right after that. So we've got about 50, and we don't even know of that 50 million ounces, how much of that is held by private investors who are willing to deal that into the market. We do know the benchmark on October 10, there was 140 million ounces in the vaults not owned by ETFs, and that the free float on October 10 was roughly 0.
Wow. That's crazy. That's really crazy. And now we get into some questions that I think kind of try and connect the dots. So we've talked about the internal weaknesses, but the external dynamics are shifting rapidly too. And let's start with talking a little bit about the global East versus the global West shift. Now, for years, all of us have talked about this steady flow of physical metal from West to East, with China now centralizing its metal through the Shanghai Gold Exchange. And now we're told restricting silver exports, along with the U.S. classifying silver a critical mineral, and they too can restrict exports. Do you see more so forget about the U.S., I just want to throw that in there as a plus. That's happening too. But do you see what's happening in Shanghai as a direct challenge to the LBMA's role in global price discovery, and maybe even more so towards market dominance? Is this a real threat over time?
Well, I guess it depends on the various axes of power, who aligns with whom. When we look at the BRICS nations and the countries that are friendly to the BRICS, it's more than half of the world's GDP now. We really rely on the London market in terms of price discovery of gold and silver, in terms of feeding information into the bond market. We learned historically in the 1970s how essential gold and silver were as a warning system of excess currency creation. Silver went up by 24 times in 9 years, and gold went up by 21 times in 9 years between 1971 and 1980. And in 1987, the LBMA was created, and the daily fix, as they called it, gold and silver, was created using these promissory note contracts, which essentially moved the market away from trading metal to a market that traded promises for immediate delivery of metal. And for more than 20 years thereafter, we had the gold and silver signal was switched off while very loose monetary policy was run by these central banks. They called that, the Wall Street Journal wrote an article in the 1990s talking about the Great Moderation, which was that, this is incredible inflation after we've dumbed down the inflation measure through the CPI is showing us that we've got no inflation, and gold is telling us that we've got no inflation, and yet asset prices are going to the moon. And this is, we've really hit now on central planning, monetary policy nirvana. And I think what we're going to have come out of all of this, Andy, is a fragmentation of the world's gold and silver markets away from these major centers. And everything is going to become local and governed by local law.
Yep.
And I think that capital investment and acquisition capital is going to go to the trusted sources for metal, and that is still to be determined. Which markets are going to be trusted, but I think China would like to be the focal point of the world's price discovery and become the dominant force. But there's lots of we've seen unbelievable levels of corruption in China over the decades. And I think people would have to be quite naive to look at these now as the fair dealers in terms of setting the global price of gold and silver. So I think that everything becomes local after this, and it's who has the metal and where are the repositories located in terms of laws that enforce the contractual right to acquire metal.
The growing strain inside the global silver system is becoming unmistakable as repeated delivery delays, surging lease rates, and shrinking available inventories expose the structural weakness beneath the surface. Recent disruptions have revealed that large daily trading volumes sit atop a fragile physical base, creating a delicate environment where even modest shifts in demand can overwhelm supply. As additional metal is rushed in from multiple regions to stabilize short-term needs, the pattern resembles a rolling breakdown rather than a temporary imbalance. The broader environment adds further pressure, with export restrictions, redefined classifications, and new geopolitical priorities reshaping how nations handle critical resources. Physical possession is becoming a priority across industries, institutions, and even sovereign entities, reflecting the growing awareness that synthetic liquidity no longer aligns with real-world availability. In this environment, regional price discovery and local market trust are becoming central themes as the global system transitions toward a more fragmented structure. Let's get back to the interview.
Do you think that a failure to delivery is possible? And have you ever run that out? Like if a major bank, Standard Chartered or Deutsche Bank or whatever, were to have a failure to deliver, could that also possibly create a far greater, let's say, contagion, if you will, because these banks are not just bullion banks, they also have their finger in the pie of everything, a massive breakdown in trust.
Yeah.
Do you see that as being possible, the start of something that kind of breaks the system?
Well, I think the implied lease rate for silver a couple of weeks ago hit 39%.
Yeah.
And the implication there is that we did have a default, because you could be sure the actual lease rate would be higher than that. So I think we've had a default, and I think what we're now in is a rolling scenario of what happens when you have a default. And that is why I see silver now in the cash market running relentlessly higher again. I think London, essentially, the London silver and gold market is a smoking hole right now. And what we see is acquirers, the industry especially that absolutely needs the metal, are stepping in and trying to acquire the metal as it can. And I don't think this process is going to take too long. I think we had a default. The lease rates were telling us that somebody couldn't get metal, the implied lease rate. I don't know what the actual lease rates were, but I suggest they would be materially higher than that. And that what we see right now is a pause for a couple of weeks. 50 million ounces come from China and New York and Switzerland to kind of give a little bit of a patchwork covering to what is going on in London, but that we are now in a rolling failure of the London market. Let me put it that way.
If the LBMA were to lose control or collapse, what does the future of global gold and silver price discovery look like? Do you have any idea who would lead that transition, or what kind of system do you think would replace it?
To be determined. I don't know. I don't see any up and coming trusted sources. I think that, the New York COMEX could potentially be an important player in that. But the problem that you have is that the players in the COMEX and the rule book in the COMEX, the players are the same players in London. And so there's going to be a loss of trust here. Effectively, the issue here is a loss of trust in the market. For the market to function, you have to have trust, right? And that's what's being systematically destroyed by the revelation of the shenanigans over 40 years in the London market. And the New York market is infested with the same players that are in the London market. And we have to have our people in to have a look at it. And I think that with time, we will have established price discovery centers. But I can't see the next. Format for price discovery on a global basis for gold and silver. And I think that, as I said earlier, I think China would like to be it, but China has the government stands on a heap of bodies, and it's very, very tough. You look at over 70 million people killed throughout history by their government, and it's very tough to say, well, we're fair dealers and trust us.
China is the world's largest silver refiner, and now they have just publicly said that they will be restricting exports starting in 2026, and that all exports have to get individual government licenses, effectively giving Beijing full control of every ounce leaving the country. And this is, as they mentioned, it's a resource of national interest. At the same time, the U.S. has added silver to a now critical mineral list for the first time. They're citing its essential role as a strategic asset rather than simply a commodity. The bottom line is silver is being redefined from an industrial metal into a geopolitical resource. And this to me says a potential supply crisis and rising strategic value by the big money is coming into play.
China is producing a lot of silver, but it's a huge portion of it is coming through its refineries, its base metal refineries. And we know that 70 to 75% of global silver production is a byproduct of base metal production. And so China does play an important role in terms of the refineries that it has operating, but refineries can be built relatively quickly. And the flows of concentrate from these overseas miners can be altered quite quickly as well. So not trying to be evasive, Andy, it's just that so much of this is in flux right now. And, so many of the trusted sources are now being seen to be not trustworthy. And it's just a matter of time for this to shake out and to see where the consensus. And we may go through several rounds where one location becomes favored and then falls out of favor. So I wouldn't write North America out of it yet. Canada and the US. Mexico is another question in terms of the direction it's headed in. And it is the primary producer of silver globally, right? I mean, the US barely makes the top 10 in terms of silver production, and Canada is not even in the top 10. But we're going to see regional centers set up, and ultimately, I think a lot of it comes down to enforceability of law and the basis of that law, and ultimately trust. Who do you trust? And I think we're going to find out now who we can trust, but I think we can certainly see who we can't trust. And I would argue that that's the major bullion banks, including the Chinese. ICBC is a major player in the London gold and silver market. in terms of operating their price discovery platform, which is called Orem. It's run by 4 major bullion banks, including ICBC, JP Morgan Chase, and HSBC as well. So China is not immune to the accusations that they've been participating in a fraudulent system, and we're going to have to see how this shakes out. But in the meantime, I think everything comes down to possession in the short term. I think more and more players are recognizing that if they don't have the metal, that they've got a serious issue if they're absolutely needing it in the future. And that now there's a movement to see who gets the 50 million ounces that were imported into London. And I think that the price action is telling us that small injection of metal into that market doesn't have long to live in the London vaults.
No, it doesn't have a lasting effect for sure. And my 2 cents on that is I think China's playing the game. They're beating us at our own game. The West held the prices down to support the illusion of strength of system and maybe to support the military-industrial complex with the massive amount of silver needed. China says, we'll beat you at your own game. We'll join in on the suppression and we'll just stockpile it. But that's just my 2 cents. Again, a lot of the information I gather from you.
Yeah, I wouldn't be surprised if China has 2 to 3 billion ounces of silver that they've acquired over the decades in vaulted stock.
Right, beating us at our own game.
Sources. Yeah, whether it's private or government sources that hold that, it's indeterminate. But there are 25 billion ounces of silver above ground, and we just need much higher prices and time for this metal, which has been forgotten because of the very low price level, to be rediscovered and brought to market and refined into the correct form to meet exchange requirements.
The underlying structure of the global silver market is shifting in ways that are becoming difficult to ignore. Delivery stress, rising lease rates, and a market operating on razor-thin physical float have exposed a more profound vulnerability that has been building beneath layers of paper liquidity for years. Recent signals, from extended settlement delays to massive daily trading volumes unsupported by available inventory, suggest that traditional price centers are operating on borrowed time. Each emergency shipment of metal into the system provides only temporary relief, while demand from industrial users, investors, and sovereign players accelerates. Alongside these structural pressures, geopolitical realignments are transforming how silver is treated at the national level. Restrictions, reclassification as a strategic resource, and competing regional hubs are redefining what price discovery even means in a world where trust in legacy markets is steadily eroding. As countries tighten control over exports and prioritize domestic stockpiles, physical availability becomes the most valuable signal. This shift marks a transition from a globalized, centralized model toward fragmented regional systems anchored in real metal and enforceable local law. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.